Okay, I think in the interest of time, let's start going. So first of all, good morning, everybody, and good afternoon, Geoff. Thank you so much for joining us from Sydney. Today we're talking about a topic I think that is quite, it's on the mind of most of us, whether it be now due to the pandemic or just as an Australian living abroad and thinking about possibly, or an Australian Irish, thinking about possibly going back at some stage, whether it would be in 6 weeks, 6 months, or 16 years. I think it's something that's on our mind. So this is a great opportunity to discuss going home and talking about, finances, taxes, and how do we prepare ourselves for making that leap of going back to Australia. I couldn't think of two better experts to guide us through this process than Geoff and David. Geoff is an expert in personal super and taxes. Geoff joins us from Sydney, from Majenda Australia. And David, who's a member of ABIE, is CEO and director of Black Swan Capital. So now over to Geoff and David. Let's start with Geoff. Geoff, if you could give us a brief introduction and talk about basically, what you do on a daily basis, and then we'll get into your presentation after David's. Just a housekeeping rule. Let's save questions until the end. We've got a lot of information to give you. And so if you could jot down your questions and then don't bother going through the Q&A. We can do questions, on the fly after the presentations.
Okay, so just to give an introduction to myself, I've been looking after expats for 15 years, mainly focusing on the Middle East and Asia, but more recently the UK and Europe. So I've had a lot of inbound expats over the years and had to deal with a lot of challenges and to do with what to do about superannuation, pensions, tax obligations, and so on. Over the last 5 years, I've done a Masters of International Tax, which has allowed me to be across the issues, international tax issues from one country to another, which do vary, and that's the key to any advice I provide. I'm a financial planner qualified to provide advice only in Australia, which is, I would never provide advice on any overseas products. That's in David's domain. But I can provide any international tax advice. I'm what's called a chartered tax advisor, so I can advise on how to get yourself set up ready to repatriate to Australia.
Thank you, Geoff. Thank you. David, over to you.
Thanks, Jennifer. And yeah, thanks for putting this on, Abby, to Jennifer and Haley and Michelle. And it's good to be talking with Geoff, sharing the presentation with Geoff this morning as well, or this afternoon for you, Geoff. So for those who don't know me, I'm David Bellingham. I head up Black Swan Capital here in the Netherlands. We're on the Herengracht in Amsterdam, and we specialize in helping expats, international professionals, whatever you want to call us, people living outside their home country in Europe with their financial and investment needs. A large part of our group are Australians, fundamentally because I'm an Australian. I left there in 2006, and I've been in the Netherlands since 2014. I had to think about that. So, and we look after expats. We have an investment firm, an independent and unrestricted license from the Dutch regulator, the AFM, and we're overseen by the Dutch Central Bank. Pardon me, Dutch Central Bank. So we provide investment advice for expats, and a lot of that work is helping internationals, whether they're in one of three categories: the type that say we're never going home, the type that say we don't know where we're going, and the type that say we're definitely going home. And so it's, I think in any case, it's quite relevant in terms of what Geoff and hopefully I'll present this morning.
Thank you, David. So the way that we're going to set up the webinar today, David's now going to give his presentation, and then that will be followed by Geoff's presentation.
Thank you, Jennifer. I'm just going to go to the screen sharing. So give me just a moment while we set this up and juggle around and get it working correctly. I've got some slides to accompany the presentation. as quickly as that goes. And I think I need to switch the screens I'm looking at. Jennifer, are we looking at the right screen?
Yes, we've got the presenter's view at the moment.
Oh, I thought that might be the case. Thank you. I'll switch that around. This happened earlier, didn't it? There we go. That should be better.
That's better.
Okay, so just to start with, hope you find some of this interesting and relevant, but as a disclaimer, it's not advice. So this is general discussion. So please don't act upon what we say specifically today, but go and get advice to make sure it's appropriate for your circumstances, whether that's with Geoff or us or somebody else. I want to go through some main topics around managing your money and investments here in the EU, in the Netherlands specifically, in the context of your pensions and your investments, in the sense of what's going on in the broader economy, and some of the principles that should apply in general, as well as specifically to Australians. The way I've done this is focusing on some of the main questions that we get, particularly from Australians when it comes to managing their money in Europe. And here they are, some of the main things that we hear about under the umbrella of where and how should I invest my money? What should I do with it? The questions we most receive are around things like pension schemes. Should I invest more into my local pension scheme? Active versus passive investing, and what about ETFs? What is ESG as people start looking into the details? Whether property is a good investment, and if it works here the same way as it does in Australia. The impacts of 30% ruling if you're fortunate enough to have it, and the wealth tax that exists here. We inevitably get questions about cryptocurrency, so I'll touch on that, and questions like, should I be in stocks? Should I just stay in cash? What should I do? And what does all of this mean when I'm heading back to Australia? So I'll go through these, some slides, and answer these questions along the way. First of all, I'll talk about, I guess, under the heading of globalized economy. I thought it'd be very exciting to start looking at some graphs, but to talk about those questions about where should I be investing and what's going on in the market to influence that. On this page, I've got 4 graphs. In the top left is the Euro stocks, the Euro 100. Beside that, the FTSE, the largest 100 stocks on the London Stock Exchange. In the bottom left, the Dow Jones, the New York Stock Exchange. And in the bottom right, the ASX 200, the Australian Stock Exchange. And at a broad level, we could say there is a globalized consistency in what's happening in the markets, which means that when you're investing, that it pays to be global. But in a broader level, you might say, well, wherever I'm investing, the markets are going to do something broadly similar. We saw it drop in March last year because of COVID and recover. We saw it drop again around the time of the US election and recover. But digging a bit deeper, there are, I guess, some divergences there. If you look at the London Stock Exchange in the top right, they certainly had a lot more uncertainty late last year around Brexit and what was happening, whether they were going to get a deal or not. We saw the same uncertainty in the US around November at the time, or in October, indeed, leading up to the US election, and then subsequent to the election, a strengthening in the markets. And in Australia, a flattening of the growth this year as a demonstration of the China trade issues that they've been experiencing. So we do see some variances between markets if you look a little deeper, which to me reinforces a couple of points when it comes to managing your money around the world. And one is that it is advantageous to be diversified across markets. But it also points out something that we've seen in the last year and is certainly continuing, and that is the value at this point in time in being active rather than passive. So in that question of should I be actively managed or should I just go into index trackers and passive funds? Well, the real answer to the question is it depends. And in different points in time, the answer will be different. And for different individuals, the answer will be different. But at the moment, in the last year and going forward for the foreseeable future, we see some real advantages in being actively managed just because of the disparities in the market. In the markets for a lot of last year, we can see in the graphs, if you look in a bit more detail, that they recovered rather differently last year, and different sectors performed rather differently. So some of the key anchors in some of the indexes, of which index trackers have to follow, underperformed things like travel stocks last year, as you can imagine, shipping and transport, and commercial property with things like shopping malls and so forth, all did very poorly. Whereas biomedical, healthcare and tech stocks did exceptionally well. The FANG group, Facebook, Apple, Amazon, Netflix and Google did very well and are still doing reasonably strongly. So we can see some opportunities in markets where they're not all operating in the same way, perhaps in the same direction. And therefore, there are some potential, I guess, opportunities to be actively managed rather than passively managed. And we can overlay geography with that as well. And I've just put this one up as an example. This is the Hong Kong, the Hang Seng market. And we can see how it's been at best flat this year, which is really a representation of China's tightening there in the one country, two systems approach as they move forward to the full handover. And we can see how that's impacted that market as a proxy, an example for some of other markets in the world that aren't necessarily all moving in the same way at the same time. And the point, I guess, in reference to that, though, if you're going home in a couple of years or planning retirement in a couple of years, those discrete movements are really important. If you're looking at 10 or 20 years away, they are less so. So that dip we can see in the last month in the top left there on the Dow Jones and New York Stock Exchange is barely discernible in the 10-year graph on the right-hand side. So the point being that these points of volatility smooth out and decrease in intensity over time, such that the markets will grow over time, but not in a straight line. So if the goal is long-term, so the focus should be long-term as well. And dare I use the expression of a black swan event, looking back at previous events that have happened, markets inevitably crash. The markets we're in now will crash again. It might be next year, who knows when it will be. There may be a black swan event that will happen, such as COVID, such as some of the points on the graph here. The point is the markets do recover. What the circles and the lines around them show is the magnitude of the drop and the time in days it took to recover. This was done in the middle of the February-March 2020 COVID crash, where the markets dropped 29, ended up being 30%. But before they recovered, and they recovered in just a matter of weeks. And other times it's taken a lot longer, but inevitably over time they will. Probably a bigger threat to longer term investments than the stock markets is really inflation. We've been talking about this for quite some time, and it impacts us on a couple of levels. And we can see that if you look at the end of that graph there, it really is increasing from a very low base, but it is increasing at the moment. The real question is it just a temporary adjustment as we've come out of lockdowns and business and economies get back to trading normal, if you like, or is it a more sustained cyclical piece of inflation that's going to stick around for a lot longer? That's I guess the unknown right now. But it affects you in a couple of ways. One is the value of your investments and how they will be, or how much they'll be worth in the future. So that future value, because the higher the inflation, the more you need to make in return to keep pace with inflation, to stop your value of your money eroding. And the second way you feel it is in everyday living, in the cost of living, as groceries at the Albert Heijn store get more expensive and the petrol prices go up at the pump. And we see that we're probably all experiencing that right now. The value of your future money is probably the most important one. And that's where the danger of sitting in cash is quite pronounced, that if you do sort of hold out and stay in cash, you're going backwards by the rate of inflation. And as it's heading up to around 3%, that means your purchasing power halves every 24 years. So that's just something to keep in mind, that cash is not necessarily safe. I've just included the Dutch inflation as a comparison. It is, as you'd expect, a little bit lower than the EU aggregate because it's one of the stronger markets and stronger economies, but it's still trending very much up, which to a degree is inevitable as we've come out of COVID economically in terms of business activity. But the issue will now be to control it. Central banks don't like inflation. They try and keep it between 2 and 3% in the long term. So there'll be a lot of pressure to keep that down, which means all the money they've spent in the last year might come out in other ways, maybe in higher taxes in the next few years, which is another thing to consider, or they'll kick it down the road to the next election and elected parliament, which is also an option for some governments, but effectively it has to manifest in one way or another. And we've seen that in oil prices. I've just shown here, oil price just hit $75 a barrel earlier this week. So if you do have a car and if it still runs on petrol, you'll see that it's more expensive to fill the car up than it used to be. It actually dropped to negative $36 a barrel just over a year ago, which is the first time it had ever been negative. So people were paying you to take their oil if you could find somewhere to store it. It's rallied back up again and it's now up at 75. So that's just an example of the inflation that's occurring that's affecting you potentially day to day. What does all that mean then in terms of how you manage your money and what you should do? Well, the first thing is, I think, to stay diversified and to focus your diversification on what your objectives are rather than driven by what the market's doing in any particular day, but just adjusting for the markets and the stages of the cycle that we're in, but focusing on the long term. Whether you're conservative, whether you're aggressive, whether you're moderate, stick to your long-term goals, invest according to your needs, with an understanding of your risk profile so that you're not laying awake at night worrying that you're either getting an insufficient return or you're experiencing too much volatility. But let that and your objectives be the driver rather than anything else. The other thing that I would touch on before circling back to those questions is the exchange rate. If you're looking to go home in the future, exchange rate is important. It's important to understand where it's going. This is a longer term graph there for a year or more of the exchange rate. It is reasonably stable, but exchange rate is somewhere that may show variability. If interest rates are kept down, it may manifest into exchange rate. So keep that in mind. 63 cents if you're looking at it the other way around. We would like a weaker dollar if we're going home so we can buy more of it, and a stronger euro. Most countries, or most regions, if we look at the EU, are in a bit of competition at the moment to see who can have the weakest currency, because it helps exporters and helps their economies. So the US notably and the Eurozone are trying to keep their economies, well, their currencies, I should say, weakened to variable impact. I think Australia's trying to do the same thing. So looking at those items there, I've talked a bit about active and passive investing and should I stay in cash or stocks. I'll talk a bit about ETFs because they're just an asset class, really, which also cryptocurrencies, I guess. Well, ETFs really a means to an end. If you've heard this expression, it means exchange traded funds, and it's a cross between a mutual fund and a stock, if you like. So it holds a diverse range of assets like a mutual fund, but it's cheaper and it's traded on a stock exchange like a stock or a share. So they're a nice hybrid. They can be really good solutions and a good way to get diversification, so you're not putting all your eggs in one basket, just holding the shares of one or two companies. And so they're a means to an end rather than anything else, but it's a question we often get asked. And we get asked at the same time as things like ESG and what does that mean? And so I'll touch on that. That stands for environmental social governance. And it's probably a relevant time to be talking about that. There's been a lot of discussion at G7 and even EU meetings around reducing the carbon footprint, around improving the ecological state of the world. And one of those ways is to encourage investing into environmental, social and corporate governance positive investments. There are sometimes incentives, which I'll mention in a few slides time, and to do that. So for the people that say, well, what about the return? Well, the returns have been shown to be as good or sometimes better. So you're not sacrificing returns for a clean conscience necessarily, but they are a particular type of investment that are growing in popularity, that are subsidized by sometimes governments and regions, and that are designed to either avoid what they call negative areas, by maybe perhaps that's fossil fuels, or to positively, or just focus on areas that aren't too deleterious to the world. But quickly looking at cryptocurrency, because everyone's been talking about it, and I thought I'd talk about it in the context of one of the investor biases, the momentum bias. And if we look at this graph, this is the cycle of the person who invests in a momentum basis, which is the opposite of what we do when we go to the store and we look for a sale. If we go to Albert Heijn and we see that wine is a 2 for 1, 1 gratis, we'll go and buy them because they're cheap. When it comes to investing, we tend to do the opposite if we follow this bias, and we'll look at something and think it looks interesting and watch it as it increases in price, and wait until they've really demonstrated that track record before saying, right, this is hot, I'm going to buy it now. And we ended up buying near the peak. Inevitably, it will drop a little bit, and the first response we do is, well, I've made a mistake, I'll sell it. If it recovers, we'll say, well, I've made a mistake, I'll buy back in, and we've bought near the top. And then as it drops, as investments and all investments and markets go through cycles, we go through this sort of denial of thinking, oh, it'll bounce, it'll be okay. And then, we'll wait for it to recover until we get completely exasperated saying, I've had enough of this, I must sell. And this is the point where in the markets, you often hear, this time it's different. And it's my favorite marker and the thing I always look out for. When you hear this time it's different, which I always recommend to do the opposite of what they're talking about. So at that point in time at the bottom, this time it's different. The markets are going to fall forever. It's never going to recover. Well, that for me is a pretty good signal that you're at the bottom. Just as when you're at that top of the cycle, we often hear this time it's different. I think this is going to go up forever. So be aware of that. Then obviously it will return and people start going back to this time it's interesting. So looking at the shape of that graph just now, the rise, the peak, the little drop, the second rise, and then the collapse. Let's look at cryptocurrency and Bitcoin pricing. And we can see almost the identical graph, the rise, the drop, the rise again, and then the falling off the cliff. Back 6 weeks ago, we heard the stories around this time it's different, it's never going to drop, it's not like a normal asset, just like we heard in about February 1919 or February 2000, just before the NASDAQ crash. And now we're hearing this time it's different, it's never going to stop falling. So the point I'm trying to make with cryptocurrency is it's just another asset. It will act and behave like other assets. It has strengths and weaknesses like other assets, but it's quite new and it's unregulated and it's speculative, so you need to be careful. There's not really with the odd exception where there's good luck involved, not really a get-rich-quick scheme. So just tread with caution and only invest what you're willing to lose and never see again. But it will follow the standard curves, which is what I was trying to get across. I want to quickly talk about pensions, because this is an area that comes up a lot. If you're here in the Netherlands and working and paying your health insurance and tax, you'll be accruing AOV, which is the Dutch age pension. You typically accrue it at 2% per year of the full amount. So if you worked here for 50 years, you would get the full pension. Unlike the Australian age pension, it's not means tested. So in Australia, you have an assets test and an incomes test. Here you don't. Everyone who works for long enough will qualify. If you move back to Australia, you can still get it, but you'll pay tax here and then tax there potentially, which Geoff can help you sort out and advise you properly on that. But you can still get it. The age is going up from about 66 and a half now to 70. So it's quite a long way away. And the full payment is only about 75% of the minimum wage. So it might keep you in some groceries, but it's certainly not going to give you an extravagant lifestyle, which is the whole point of it. It's that pillar one, giving people just enough to subsist. So that's the AOV which you will qualify for. So it's good to keep that in mind, remember that, and then at the time you're eligible, you can apply for it. The Dutch employer and personal pensions as well are receivable, but they're taxable here and then back in Australia, so you need to adjust those. They're actually, the Dutch pension system is an excellent system. It's one of the best in the world if you're going to stay here forever. You can accrue, you can look on, there's a number of websites like Mijn Pension Overzicht, .nl, you can go to and you can actually see where your pensions are at from all sources and how much you're accruing. Again, between age 66 and a half and 70, you can become eligible, but you can't withdraw a lump sum capital in most instances. You only receive it as income, which is quite a restriction and a comparison between Australia. So your accessibility is later than Australia and your flexibility is less, but then it gives you that income later in life. And the advantage, I guess, of going to Australia is that you have a positive currency differential in that you're receiving in a stronger currency than a weaker one. There is the potential to move pensions from here to there. Theoretically, in practice, they tend to it becomes difficult and expensive. So I'll just put that to the side for the moment. The other big area that everyone likes to talk about is the 30% ruling in box 3. So if you're lucky enough to get the 30% ruling, it's now down to 5 years. And what that means is for that 5 years, you have 30% taken off your gross income for taxable purposes, and you're exempt from box 3 of your tax return, which is the wealth tax. If you finish the 30% ruling, or if, like many of us, you didn't get the 30% ruling, you are liable to do the return with the box 3 every year. The box 3 has a tax-free threshold of 50,000 for individuals and 100,000 for couples. So above that, you have to include your worldwide assets. Pensions are excluded from that. Primary residence is excluded from that typically, but other assets are included, worldwide assets as well. So remember that if you have other investments or investment properties in Australia, they're supposed to be included on here. It's I guess one of the good things about the Netherlands is there is no capital gains tax in general, unless you're a majority shareholder of a business. There is no capital gains tax, but this is in effect an unrealized capital gain. You're paying tax on your accrued wealth, whether you've realized that wealth or not every year. So if you own a property, an investment property, and it goes up in value, you're still paying on that increase on the total value that's increased, even though you haven't realized that value. It's just sitting in the property. There are potential ways, a few limited ways you can reduce it. One is to invest into your pensions, which are exempt, but you then have the restrictions that we mentioned last slide around how you receive that money in the future. And the other are things like grown funds or green funds, here back to ESG, as I mentioned earlier, which can be good. You can see there's a limit there as an individual or couple that you can invest into that can reduce your potential box 3 tax liability. But you need to consider the whole package. You shouldn't, in our opinion, invest for tax reasons. You should invest for your objectives and consider the taxes and compare where you're at. So you'd need to compare what are the likely returns from the green funds and my tax deductibility or tax benefit there versus a regular ESG fund that's not a government approved green fund without that tax benefit. So there are a few permutations there and things that need to be considered for your specific circumstances. But they are quite important because it can have quite an impact on your net result and your growth towards your retirement goals. The other thing I would like to mention is property quickly, because it is popular, and in general, you know, if you're living in the Netherlands and you're staying here for quite a period of time, perhaps 10 years or more, it does seem to make sense to be able to buy a property. The cost is lower to pay off a mortgage than it is to pay rent. Rental yields are about 4%. Interest rates on mortgages are about 1.5 to 2.5. So it's cheaper to be paying a mortgage than it is to be paying rent. You can get 100% mortgages, which is good, meaning you don't have a lot of capital to outlay, but isn't risk-free, because if you need to sell it in the near term and the market is worth less when you sell than when you buy, you're in negative equity and you have to find the difference. And that's something you really need to keep in mind. And that's the reference to this graph, which comes from the UBS's bubble index, the global bubble index of the most overvalued and even undervalued properties around the world by city. And Amsterdam was in the top 7 last year. It moved up to 6th, I think, in their reevaluation. The prior year it was number 2. So they consider that at the higher end of a market, more likely to have a bubble bursting. What happens in reality, there's a whole lot of variables that means that may or may not happen. But you need to be conscious of that. If you're buying a property in the Netherlands in the shorter term, there is that risk. And we've seen it happen. We've seen clients over a period of 5 or 10 years actually go backwards with real estate in the Netherlands. So it's not guaranteed. But if you're living in it as your primary place of residence, it's meeting a lot of non-financial needs and seems to be, in the longer term, a sensible idea relative to renting a property. The second aspect of that is investment property, and we're all very familiar with that in the Australian context. It works a little different here. The banks tend not to like lending for rental properties principally because the tenancy law is very much in favour of the tenant rather than the landlord, and banks don't want to be left holding a property with little equity owned by the individual, so it's easy to walk away, and a tenant that's recalcitrant, not paying, and they've got no way of getting them out. So whilst yields can be quite good, there is that concern. So you need to take that in mind, that you'll need to put more money into it, and that will affect your return, because one of the great opportunities in property is the leverage ability. So that can change with investment property here. So that's our short overview on should I buy a property or not. So I think I've just about used up my time. In principle, what we're really saying is focus on your goals and overlay it with the reality of where you need to be, rather than be any cyclical circumstance or any particular influencing factor or trend of the day. I'm going to jump through that. And so in summary, know what you really want to get out of it to be focused on your goals, and stay flexible. I think that's a point that I didn't touch on above, but I think is really important. When we look at investment options and opportunities in Europe generally, in the Netherlands specifically, except pensions, which are governed by pension laws, we think that it is really important to stay flexible and liquid. There are investments out there that will offer a trade-off of access for a potential return. And sometimes they can be really good. At the moment, we don't think they're worth it. So if you're locked up for 5 years or 10 years, we don't think there's a premium in return to justify that, or if there's an exit fee or something like that. So it's okay if you think, well, my time frame is 10 years or more, there might be an advantage in going back to an Australia with a product that had that 10-year limitation. But if life changes, another event happens, and you are required to go home sooner after 3 or 4 years, you may find that that investment carries a substantial exit fee or penalty, which removes pretty much all the growth you've got and doesn't achieve the goals you want. So we think it's not worth it in that sense, and staying flexible is a really important thing to do with your investments. So that's our summary. And in overview summary, the 6 rules we say is look at compliance first, make sure that there's regulatory structure around what you're looking at, liquidity and flexibility again, and consider volatility, cost and returns as one. In other words, your returns should be relative to your cost and volatility, if that makes sense. So I'm going to stop it there and stop my sharing so I can get ready to pass over to Geoff. Happy to take any questions from this, and we can take them perhaps at the end after Geoff's presentation. Geoff, I'll hand over to you.
David, just in between, can I ask you to add Adam, Evelyn, and somebody else has joined, and I can know.
Of course, yeah. I'm going to allow you all in as
there we go.
Panelists. There you go. I think I have everyone.
Thank you.
We do. Perfect. Right. Geoff, I'm going to pass it over to you, and I'm going to put up your presentation now as well.
So David was talking about investing for returns, which is absolutely critical. However, tax is a big factor. So if you look at different tax regimes around the world, countries choose certain things to favour and others not. So if you're going to go from one country to another, in the case of the Netherlands, which taxes on a residence-based worldwide income, and Australia the same, but with a different set of rules, you've got to figure out what is the best way to transition and how do I avoid doubling up on tax along the way. So that's basically, you might be wondering early on why I'm focused on the residence rules, because they're important, because they will dictate how you are taxed. And so when you go from one country to another, you need to know, when you're going to be taxed as a resident in Australia versus the Netherlands. Now, I'll just start off with general advice warning. In Australia, we have to say that this is general advice because I haven't taken into account your personal circumstances. If I was giving you personal financial advice, I would take that into account and I would produce what's called a statement of advice. So that's just a legal thing. So we can now move on. So I'm going to start off with around residence and go through the ins and outs of that and the fact that it is changing. So we've got a report that was tabled a few years ago that now the Treasurer has decided can go forward to become legislation. So that's in play, and that is likely to be something that gets talked about a fair bit in the next little while. Then I'll go through what does it mean to be tax resident of Australia and what do you actually pay tax on and how can you actually minimise your position. Superannuation, superannuation is effectively a tax effective or tax-free way to save. So it's Australia's way of treating savings in a concessionally taxed way. So that's something of great interest to you as you're coming back to Australia, and particularly as you get closer to retirement. So if we think about retirement, you're going to have untaxed or exempt income coming out of superannuation if you're above a certain age, and then you're going to have taxed income, which could include your Dutch pension or other sources of income, property income. So as you get closer to retirement, superannuation is more of a factor. And then finally, I'm going to cover off potential strategies. So what are the strategies that I've seen people use and that I've recommended and other overseas advisors have recommended over the years to optimise a client's position. Okay, so everyone that's tuning in today is probably tax resident in the Netherlands now. So you'd be familiar, and David's talked about some of the particular rules. If you're just arriving into the Netherlands, then maybe you're not quite tax resident yet. But effectively, these are the types of things that are taken into account to determine whether you're tax resident. So where are your economic interests, where is your family, how long have you been in the Netherlands, and so on. Now, if you've been in the Netherlands for some time, the chances are you are now tax resident of the Netherlands, and you'll therefore be taxed on your worldwide income. So the question then is, David mentioned 3 groups of people. I'm never going back. I don't know where I'm going to, and I'm definitely going back. So this is really focusing on those that are definitely going back to Australia and maybe thinking about it in the next 6 months or the next 3 years or whatever, and what are the things that they need to do. And you really do need to plan ahead as to when you'll cease to be tax resident of the Netherlands and take up tax residence in Australia. So these are the current Australian tax residence rules, some of which go back a very long time. So there's a fairly generic rule of resides, where do you actually live? And there's a ruling around that IT 2650 that goes into a great deal of detail about what the tax office thinks of the conditions where you'd be residing in Australia. The second one is if you're a citizen or intending to take up citizenship or take up PR in Australia, you could be deemed tax resident unless the Commissioner takes the view you've still got a permanent place of abode overseas. 183-day test, same sort of principle. If you're physically present, either for a continuous period or for a number of periods that add up to 183 days, you could come into the net. And then the final test is a superannuation test, which actually applies to diplomats and certain types of government employees. So the thing is, if you satisfy any of those tests, you could be tax resident under Australian domestic law. But that's not the end of the matter. So it's quite possible that you could trigger tax residence in Australia but still be resident in the Netherlands. So what happens then? So both countries are vying, they're applying their local rules. What happens then? Now, before I go into that, the proposed change, so the next slide talks about the proposed changes. Now, these are quite draconian measures. If you compare them to other tax systems around the world, the UK, various other places, I can't think of any country that's got a 45-day rule that basically says you're tax resident if you spend more than 45 days in any given income year and you satisfy 2 of these following factors. So a citizen would basically satisfy number 1 straight away because they're citizens. If you had accommodation available to you, so no longer rented out, well, number 2 would be satisfied. If you repatriated your family, number 3, and then if you've got property or other interest in Australia, number 4. So it's not going to be too hard to satisfy all of those. And that is a dramatic change to what we have today. So what happens normally is that people would decide when they're going to go from one country to another. They would break ties, they would either sell a property or cease to be leasing a property. They'd come back to the home they had in Australia or lease a new property. And so it's very clear cut. Effectively, once they get off the plane, they're tax resident of Australia. But these rules potentially leave that, in doubt. So if we move to the next slide, Australia has 45 double tax treaties, and embedded in the double tax treaties, it's usually Article 4, is what we call tiebreaker rules. So, Australia's got its domestic rules, the Netherlands got its domestic rules. The tax treaty, which was agreed in 1976, says if we have a problem here where the individual is a resident of both states, i.e. both countries, this is the way we'll work it out. And so there we look at 3A, permanent home available to him, very sexist back in 1976. I think they've changed that in more recent treaties. And then the second one is personal and economic relations. So there are ways to determine how those rules are applied. And but ideally, you don't want to get yourself in a situation where you've got to go to the treaty to figure out whether you're tax resident of one country or another. You really want to plan ahead and say, well, this is my strategy. I'm going to leave and cease to be tax resident of the Netherlands at a certain point, and I'm going to do a whole range of things before that in anticipation, and then I'm going to switch over. I've just got a note there at the bottom. There's a lot of changes happening to treaties at the moment, something called the multilateral instrument, which is due to the BEPS initiative. So you've still got to go and look at what the treaty says. This one in particular, I couldn't find any updates on it, but sometimes they can creep in, so you've got to be aware of any changes that might occur. Of course, the tax accountant that specialises in this area will be across that. So effectively what you're trying to do when you're leaving one country is to try to wind things up so that you don't end up with income falling into your Australian taxable income and tax return that would otherwise not have been there. So for example, end of service benefits, salaries, amounts of money that you might receive after leaving the Netherlands. If you were in a situation where it had been taxed in the Netherlands and it also is then taxed in Australia, you'd be looking at claiming a tax credit for any tax paid in the Netherlands. So the idea of double tax treaties is you don't double up, but there are lots of different anomalies. So the idea that you've got this, ironclad system via the DTA, it doesn't work that way at all. There's lots of anomalies that you've got to be aware of. So as an example, David mentioned there's no CGT in the Netherlands. Well, there is in Australia. So once you become tax resident of Australia, you're paying tax on your worldwide income. If you've got property assets in New York, okay, you need a valuation, it'll be in the net in Australia. So therefore, timing is critical, valuations are critical. If you decide to come into Australia for a certain period of time and then want to go back overseas, there's potentially tax implications to that as well. Finally, there's also this maybe obscure rule: if you hold a lot of foreign currency that adds up to more than 250,000 Aussie, the tax office will want tax on that if you make a gain. Equally, if you lose money as well. So basically they're saying anyone who's got more than 250,000 is treated a bit like a trader in foreign currency. Yeah. So the next slide, I've put a whole slide on this because I think this is quite a draconian measure. If you have a main residence in Australia and you have a pre-existing entitlement to the CGT exemption, it's very important not to sell the property while you're overseas. Now, this one was fought about and lobbied by many overseas councils and chambers to try and get this not to apply, but it does apply. So basically, it would mean that if you had a home in Australia, you'd lived in it for 5 years, and then you had another 6-year exemption period, which is effectively the extension of the main residence exemption, all of that would go if you sold it while you're in the Netherlands or anywhere else in the world. So it's basically a no-no to do that. You simply wait till you come back and don't sign a contract for the sale of the property onto your back. The next one is, so once you're in Australia, you're taxed on your worldwide income, including all of those different types of income. Foreign pension income, the Dutch age pension, I think, is taxable. in Australia. So Article 18 gives taxing rights to Australia. There is something called an undeducted purchase price, which just means that they give you a deduction for some of the cost of or some of the value of the pension, so it's not all taxable. So if you end up with source-based taxation in the Netherlands, and it's also has to be added to your Australian tax return, then you would just claim a credit. Capital gains tax applies effectively on your overseas assets. If you already own Australian assets, they're already going to be in the net. So taxable Australian property is in the net, whether you're non-resident or resident. And once you're resident, you get the 50% discount again, if the asset's held for more than 12 months. So there's a lot of things that come into the net. So you've got to be aware of what your tax position is going to look like. So the next slide, just to give you an idea of the tax rates, these change all the time. Under the Liberal coalition government, they're very keen to see, you see this 30% rate. Hopefully this will happen. It's legislated. Some pundits are saying it can't happen, it can't be funded. But at the moment, we're hoping this 30% band, which goes all the way from 45 to 200,000, will come into play, because it's a better regime than what we have today. Don't forget, you've got the Medicare levy. It doesn't fund Medicare. It's just a tax. So those rates on the left-hand side, you add 2%. So that means the mid rate from 45 to 200 would be 32% if we get out to 1 July 2024. So the next slide, I developed this some years ago and I've updated it many times because these rules change all the time. And you might say, superannuation, why would I bother? Well, the reason that you would bother is because in that second dollar box, once you're in the pension phase and once you're drawing down a pension, not the age pension, but a superannuation pension, you've got no tax on income, capital gains, or tax on the pension payments. So it is a pure tax-free environment. It's the opposite to what operates in other parts of the world. So there's exemptions around pensions during the accumulation phase, obviously in the Netherlands, but then they tax money on the way out. Australia just does it completely the other way. So we tax money going in. The concessional contribution there, I've mentioned 27,500 taxed at 15. We then tax at 15 on income and 10 on capital gains inside the fund during the accumulation phase. And then we go to this exemption at the end for amounts up to 1.7 million in the pension phase. We can thank Paul Keating for this. He's the architect, 1992. I've read many articles on this. It probably can't be changed. To go and change it to a system like operates overseas is probably impossible. So you've just got to work around it. So the more you have in super, obviously, the bigger your future tax-free pension can be. And you can, if you're going to retire to Australia, and because you can only put in 110,000 a year of the non-concessional contribution, potentially 3 years in one go, it means that if you're going to get anywhere near 1.7 million, you're going to need a long lead time. So many of my clients would, you know, with the intention of returning to Australia in the future, be putting in the 110 a year now. So they might have 5 years to go and they'll just put the 110 in a year as they go, even if it means paying a bit of tax on that money to be able to, I guess, tilt the playing field to the point of having a substantial amount in what will be a tax-free environment. And that means that there are other sources like the Dutch pension, property income, personal exertion income, if they're continuing to work, would be taxed at the graduated rates. I've got there a point there about the work test. Previously, or currently, there's a work test rule that basically says you need to be working for 40 hours in a 30-day period. If you're above a certain age, 67 at the moment, that's out the window. The government plays around with these rules all the time. The minimum pension drawdowns currently have been halved for this year, 2021, and again 2022. So that's an opportunity for people that have got more in super than they need. They can actually retain money inside of super and only pay out a lesser amount in pensions. So I guess the other point about this is that the closer you get to 60, the more super is relevant. If you're 40, it's probably not relevant at all. you're probably not going to be focusing on it because you'll think 20 years is a long time to wait. So that's generally what I would see. I would see people that have got some time. If they're in the, I'm never going back to Australia, then what's the point putting it into super? Probably limited. If they don't know where they're going, it doesn't actually matter if you go to Phuket or Malta or other places, other tax havens or countries that have territorial tax systems. You can still have superannuation paid out to you on a tax-free basis. So super can work for you even if you're going to be in one of those countries. If you are going to Australia, clearly it's going to be part of the picture. So when it comes to taking lump sums, so we've talked about pension income. So what about if you take out a lump sum? And this is where it gets tricky. So if you are taking money out of a pension scheme and putting it into an Australian super fund that can accept transfers, and the overseas scheme is a foreign super fund. Now that is a technical definition. So it is possible to put money into super with the same contribution limits just mentioned on the previous page. If you wait until you're back in Australia for a period of time, they'll want to know about the applicable fund earnings, so they effectively work out how much the fund has earned during that time, and it goes on from there. Now, there's also another thing that's reared its ugly head. The tax office thinks certain types of funds overseas are not foreign super funds, and they've enacted, or they're using Section 99B, particularly relevant for my clients that are in the UAE, Emirates pilots as an example, where they're taxing all of their accumulated savings in their provident fund when they get back to Australia, irrespective of the fact that they might have been overseas for 20 years. So it's quite a draconian measure. There are ways around the problem. So what it means is that not every overseas scheme meets the test of a foreign super fund. So the rules can vary. If you go to the tax office website, it'll tell you all about applicable fund earnings. It'll make the base assumption that the money's coming from a foreign super fund. Behind the scenes, we know the tax office is saying that some overseas schemes don't meet that test. So, and then they're applying Section 99B. So there's some inconsistencies here, and this is why advice is absolutely critical. I had my first Section 99B case about 3 years ago. I couldn't believe it. I objected against it. I didn't think it was possible. And then a tax professor told me it was, and the tax office did have the right to tax it. And so we then moved to Plan B, which was to work around it. So finally, tax-driven strategies. So if you're coming back to Australia to live, as a general principle, the government would like you to have your main residence paid off before you retire, and that would generally be the advice that I would provide as well, because interest paid on a mortgage for your main residence is not tax deductible. So you want to get rid of that as quickly as possible. As I said a few slides ago, don't sell your main residence while you're overseas. You'll just eliminate your CGT exemption. Potentially, I mean, what I see people do is they simplify their position while they're overseas, particularly with a tax focus. It may well be better to sell a property before returning to Australia. You've got to look at where that property is. Is there any source-based taxation in that country? And then what are the implications if you hold the property? I've got one client with properties in New York, Portugal, Spain, Dubai, and he's repatriated to Australia, and now he's going back to Dubai. It's a challenge, you know, tax-wise, for him to work out what he needs to do. But they're the sort of things that he could have simplified his situation before he came back, and that might have been easier. Gearing on properties does make sense because it is tax deductible, whether it's an overseas property or not, you can still get a tax deduction. With super being a focus, you know, you've got access effectively from 60 for some people, a younger age if their preservation age is lower. But normally people would start to boost their super from 50 to 55 onwards with a view to retiring in the medium term. The foreign life policy is an anomaly. They're available in various parts of the world. They're tax paid if held for greater than 10 years if they satisfy the rules, Section 27AH. Your overseas financial planner, David, would be able to tell you what these are like, you know, what sort of advantages there are, whether they're available and so on. And then finally, when you do come back, applying for the UPP calculation on your Dutch pension, that's something that we can do as tax advisors, and it's basically will save you some tax. Effectively, all of these things will be age related and time related. So depending on how old you are, how long you intend to stay overseas, and when you want to retire, all of those will be factors in determining what strategies will work best for you. Thank you.
Thank you, Geoff. Thank you, David. It's really, really interesting information, and I saw everybody looking intently and listening intently to what you were saying. Unfortunately, a couple of people have had to go, but here's a great opportunity for everybody to ask both David and Geoff those pressing questions. You've got some fantastic experts here, so please feel free to ask questions. So I see some hands up already, so please go ahead, Chris.
All right, this is a question about investment structures. I'm in the funny position of still being an Australian tax resident because my wife's a diplomat. I invest mostly through a discretionary trust and bucket company in Australia. And I'm debating before I leave the Netherlands, is it worth setting up an investment structure here? And is there any tax advantage to doing so?
For an Australian tax resident, I think you'd have to ask David. So you're basically number 4 on that list of residence tests. So what that means is you need to optimise your tax position the way you would, the way an Australian resident does. I can't think of any structures that would help you in the Netherlands to avoid Australian tax obligations, though.
David, do you have an opinion on that? David, can you hear us?
Sorry, my apologies. We had a power blackout just as we were answering.
Oh, you might have been blacked out. Yeah, so I can't think of any structures, but I can have a look at it. Normally what you'd be focused on is just the normal sort of superannuation, negative gearing, and those sorts of things. I guess you're going to have the problem of if your wife's a diplomat, she's probably going to go from one country to another.
Yeah, so it's really about structures that can sit there long-term running as a structure. So super, I've already hit the balance transfer cap, so that's not really an option. And it's about structures that are mostly for holding equities in the long term to internally compound as opposed to distributing income. And the Dutch corporate tax rates are quite attractive, but I don't know if there's a problem holding that from Australia.
Yeah, so a Dutch corporate could be a CFC if you came back. So CFC would give you problems. It wouldn't work for you as an investment vehicle. It might work for you while you're overseas. Yeah, no, CFC wouldn't be a good thing. So I think let's have a look at it offline and see if there's anything that could work for you.
Thank you.
Rolly, I see you've got a question as well.
A question for Geoff. With those new residency rules that you were talking about, tests that might be coming in, and also I heard that there was a sticky test of a residency rule about, because I only moved to the Netherlands from Australia about a year ago, and so there's a potential 3-year period almost that's going to be in play for people that are leaving Australia, and there's a sticky rule that they might be still captured as Australian residents for the first 3 years that they're out. When do you anticipate that being sort of coming into effect, if it does come into effect, even though it's already been talked about, but it hasn't actually been, legislated for yet?
It will come into effect, but the way it's written is that it will come into effect from 1 July after the enabling legislation. So that means either 1 year away, because it's not going to make it by the 1st of July this year, or 2 years away. I wouldn't think it would go that longer. So I think it would be probably 1 July 2022, but I don't think it's going to affect you, because if you stay overseas, say for 2 years, and you've got a permanent base in the Netherlands, then you would just have a look at IT 2650, and if your intention is to be away for the long term, I think you'll be fine.
Okay, but if I did come back after that 1 July 2022, and they've enacted that law, so I left and came back within 2 years, even though in the 2 years that I was away, I had no intention to be in Australia, but for family reasons, I might go back. My mother's quite elderly now. If I did that, I just am wondering, like, would you get tripped up by that law or by the 45-day rule if I choose to stay here but go to spend some time back in Oz and it's more than 45 days?
So what you would do is, if you maintain a permanent home in the Netherlands, even if you were above the 45 days, you would claim the treaty rule, the tiebreaker rule in favour of still being resident of the Netherlands.
Okay.
So
Okay.
I think you'll be okay. So the current rule effectively for going overseas is nominally 2 years if you read IT 2650, which is 30 years old and a terrible document if you ask me, because it's so wishy-washy. But if your intention was to be away for at least 2 years and you physically stay away for 2 years and you're living there with your family, then no problems with being Dutch resident. And then you don't easily eliminate that just because you come back to Australia. The Dutch authorities are not going to just let you go and say, oh no, you can go back to Australia and they can tax you over there. They will say, no, you're clearly tax resident and you stay tax resident under the tiebreaker.
Thank you.
Yeah.
So Geoff, the complexities around that ruling, though, are the different tax years, and you know, what is the formula? What are the equations for doing that? Because you know, when I look at it in the detail and go right to the middle, is it 45 days Australian? Is it 45 days Dutch? Is, you know, it's quite complex when you look at it. I mean, even when I'm trying to sort out interest and non-residents withholding tax that I pay in interest in Australia, and I have to put it into my Dutch tax form, it's a nightmare because there's a split that needs to happen because it's not a calendar year, it's an Australian tax year.
It's a great question. And it gives tax accountants that do this sort of tax work nightmares. So in terms of the part year, Australia allows you to say via your tax return, I became resident on a certain day, and they'll apply the part year tax-free threshold. So that's the only way you can really tell the authorities, oh, I've become tax resident on a particular day. And that would normally be the day that you came off the aeroplane and you said, now I'm here to stay and I'm going to my home, which is my permanent home, and I no longer have a home in the Netherlands. So you then try to get that to line up in the Netherlands as well, using whatever part year rules are available to you there. So theoretically, it should be just a smooth handover where you apply the part year rules of both countries, and then you say, well, I'm going to be taxed in Australia on my worldwide income from that date. And when we prepare a tax return for someone who's overseas, we only prepare it in respect of taxable Australian property income. And then when they come back, we say, okay, as of that date, let's add up all of your worldwide income and away we go. Now, when it comes to split to the fact that the tax years don't line up, what I would suggest is a spreadsheet that's got 1 6 months and another 6 months, and maybe in the 2 different currencies. And that's normally the way we would do it, where if you keep track of all of the payments for the whole year, and you can split it into 2 lots of 6 months, one for the Australian tax authorities and one for the Dutch. And then it's a matter of when do you claim the credit and the timing differences. The tax accountants just would work around that, whatever seems logical to do. So you present them with the information, say, you know, you figure it out.
Okay, thank you. I see Eve is grinning there. Have you got a question?
Oh, I've got so many questions. To be very frank, just a really odd question. Has COVID made any difference? Because to some degree, I'm in the Netherlands because it's difficult for me to get back home. And so my status is very bizarre. I'm still working out of Australia, still being paid out of Australia, and I still consider myself to be an Australian tax-paying resident, and I have not written into the Dutch system. So I'm just worried, you know, there's nothing else I can do, but is there any, do you think there is any implications I need to be mindful of going back in September?
How long have you been in the Netherlands for?
Since March last year.
So you'll be away for less than 2 years?
Mm-hmm. Yeah.
So I think you'll be okay. You just, as long as the Netherlands doesn't expect you to lodge a tax return.
No, they won't. No.
Does your company want to deduct tax and pay you locally? They're just paying you from back in Australia, are they?
Yeah, they're paying back in Australia. Because most of my work I'm doing virtually, so it doesn't really matter where I am physically.
So the Dutch authorities would probably say, no, if the work's done in the Netherlands, you should be paying tax locally.
Mm-hmm.
But if that's not happening, I think you'll just say that I'm still tax resident of Australia.
Yep.
And clearly you're tax resident under the domestic rules until you can prove otherwise.
Mm-hmm.
So I think it's going to be okay. But there'll be anomalies like this because of COVID, and I think there'll end up being tax cases as a result because people are going to get stuck in countries.
Mm.
And their intentions are going to be thwarted. I have a few clients in this situation that, you know, they've been stuck in Australia and wanted to be back in Dubai or wanted to be in another country, and it's potentially changing their position because it's different to what their intentions were. Yeah. But I think if you're solidly tax resident in Australia and you're going to spend less than 2 years away,
yep,
and the Dutch authorities haven't logged you into their system and given you a tax file number and all those things, yep, I think you just carry on as if you're still tax resident of Australia, right, and that's it.
Okay. Thank you.
Yeah.
So, Geoff, if you were to be considered as a tax resident in Australia, surely if you have property and you're charged the 50% capital gains, surely that would be reduced, right? And then we would be allowed to vote again, correct?
Well, that's right. So Evelyn, in Evelyn's case, she can just continue to vote. She gets the 50% discount if she owns property assets, and you know, she's not out of the system. But if you come back into the system, yes, of course, you're going to be able to vote, get a Medicare card, do all of those things. I guess the key thing is not to prematurely be caught in the system before you wanted to be, or not know what the implications would be. And I've dealt with a few of those cases over the years where people would ask me after the event, and then it's too late. So it's always better to ask the question prospectively and say, if X, Y, and Z, what would be the implications, so that you can then make a valid decision.
I mean, looking at tax rates in Australia, in some respects, it seems attractive to be tax resident of Australia rather than the Netherlands, just from a helicopter view.
Yeah, some people say Australian tax rates are high. Certainly the 47% bracket is, but the lower brackets I think are reasonable and have gradually decreased. So the tax cuts that you see there were scheduled for further down the track and got brought forward under COVID. So there was a lot of debate some years. They had the omnibus bill where it was argued about forever, all these changes, and finally they got them through. So I think the tax regime is more favourable than it's been in previous years.
Okay. Yeah. Any other questions?
I have one. I have to say, thank you very much for your presentation. It's very succinct and rather clear, but I have to say on this subject, I'm lost. But I'm a dual citizen, so I was given Portuguese citizenship by my parents who immigrated to Australia, but I was born there, and I now live in the Netherlands for the last 20 years. In fact, I have bank accounts also in Portugal, and my parents also hold property that one day is likely to become mine. And I'm just wondering how the fact of being a dual citizen and having or property or assets in various places might also affect coming back to Australia? And would all of that just be put into the what you would call the worldwide income?
Yeah, so your Portuguese properties outside the Australian tax net. So if you inherit those properties at some point in the future, until the day that you become tax resident of Australia, and at that point you would get valuations, as high a valuation as you can get.
Right.
Now, is there capital gains tax in Portugal?
Yes, there is. There is, Geoff.
Okay.
Okay. So most first world countries, European countries, have tax on property, immovable property, the French call it, I think.
Yeah.
So if you're up for Portuguese capital gains tax, then you would pay that first, and then if you also had to pay Australian tax, you get a credit for any overseas tax paid.
Right.
Okay, so you don't have to worry about it now.
No.
It sounds like it wouldn't be taxable in the Netherlands, property assets held overseas, if there's no capital gains tax, other than those rules that David was talking about. So, but the key thing is, when you move to Australia, you've then got to look at, do you want to keep those assets? And that's normally the key issue. Do I want to keep these assets if they're going to be taxed? And, you know, so that's really the repatriation process, is unpack all of your different assets, and then how do I now optimize that for the Australian rules when I'm moving? But whilst you're in the Netherlands, I think you're fine. Everything can just go as it is.
And the fact that I have a dual citizenship, does that have any bearing on? Okay.
No, there's only, I think, 2 countries that tax based on citizenship. One of them is America, and it's a complete nightmare because wherever they go in the world, they're taxed. Uncle Sam with carve-outs and various things, but you're doing tax returns in the States, you know, until you can give up your citizenship. But it doesn't affect you, you know, in most other jurisdictions. It's all residence-based, and obviously your citizenship could have a bearing, but it won't cause you a problem if you're an Australian citizen using the domicile rule, saying I'm now tax resident again.
Okay, thank you.
I think we've got one more question. Adam, I believe you had your hand up.
Yeah, thanks. Might be a question for David. Given the, I think, Geoff, you mentioned earlier that the Dutch pension systems are pretty favourable in terms of quality. I've been out of Australia since 2003, and I came to the Netherlands via the UK. So I've got pension in Australia, I've got pension pots in the UK, and I've been accumulating pension in the Netherlands. I was trying to fit myself into one of those categories, never going back at some point. I don't have a return date in mind, but I am in my 50s, and it's kind of out there in that future kind of consideration. Would I be better trying to look at putting contributions into my Australian super at this stage? It hasn't had a contribution since 2003. Or I've heard you can try and make up for the things like the AOW in the Netherlands by paying like catch-up payments or things like that. Given I don't have an imminent return date in mind, is it potentially better to try and focus on investing in the Dutch pension system while I'm resident here?
So it's a really good question. And it depends on a few variables, such as, at what time do you want to retire? What age do you think? And what age do you think you'd like to access the money? Because there's certainly quite a degree more flexibility with the Australian superannuation system, accessing it from 60, for example, compared to the system here, which will probably be 67.5 or thereabouts for you. It's going up each year. So there's a potentially 7.5 year difference in terms of access, and also in terms of how you access. So there's a few moving parts there. Australia gives you more flexibility. Dutch will give you an income that runs for life. I think if you were to do a catch up on A of A, the ROI is questionable, given that the max you're only going to get is about 1,500 euros a month anyway. It's not necessarily a huge return on investment in doing that. So I didn't answer your question at all. I'm sorry.
No, you're just setting me up for a follow-up appointment, eh?
Oh, I miss you well.
There might actually be a few.
Adam, the other thing is the CUROPS rules would allow you to get the UK money into the Australian superannuation system.
Yeah.
Yes.
Yeah.
Probably from above 55. So I wouldn't do anything to at least 55.
Mm.
But under the CUROPS rules, money could flow out of, assuming that it qualifies, the money could go into the Australian superannuation system. So that's potentially a path. But you probably want a blend. You've effectively got 3 pots of money, so it's a matter of what's the best way to balance that as you get closer to 60.
Right, because I mean, will those, let's say, income streams all come together under the same kind of favourable terms when you reach retirement if you don't do anything with them?
No, they won't.
No, so
if you leave the money in the UK pension system, it'll generate taxable income in Australia if you repatriate to Australia.
Mm.
Right, so it won't be seen as pensionable.
No, and so that's the whole idea for CUROPS, which has a whole heap of rules about releasing that money, and this is why people do pension transfers back to the Australian superannuation system, because it will put it in an exempt environment. So that's why they would do it. And then the other sources are the tax sources. So you're going to end up, you can't avoid having a mix of both. You're going to have some tax sources of income and some exempt, and it's a matter of balancing the two.
And following that, you showed on some of the previous slides, the Australian government are allowing for sort of, catch up or large transfers into pension over a period of time. If you build up a pension in the Netherlands, are you able to kind of make that lump sum transfer, or is that something you would do? Or
yeah, so the 110,000 that I mentioned, non-concessional, you can do 3 years in one go, so it's 330 and that's it.
Yes.
And if you're above that, well, you're going to have to do it another year, 3 years later. So this is the issue. The same with CUROPS, that when you're having money, if you had more than 330,000, it wouldn't be able to flow, all of it wouldn't be able to flow into superannuation in one go. So you've actually got to plan it out ahead. Some of the pension schemes won't allow you to break it up and do it in multiple tranches. So once again, you've got to look at, well, what is my strategy? And it's got to be around a time frame, either to repatriate or to retire, or both, and then work towards that.
And if I had, let's say, surplus savings, that were net of tax, is it still a reasonable proposition to pay some lump sums into the Australian super?
So you've got to look at the relativities of what David's type of investments can earn versus superannuation. So, some of the things that David's mentioned are going to be very tax effective in the Dutch environment. So you would look at that first, and then you'd say, if I also, it wouldn't hurt to be doing a bit of both.
Yeah. Well, it does sound like a follow-up call with David then. So I heard the click and the bear trap snapping shut. All right, but I have to say I found this really informative, and I think it was an excellent opportunity to just get even an overview of what is, I think most people would agree, is a really complex topic to try and even keep on top of, and the fact that the sand seems to be shifting underneath you all the time. Doing things in the wrong order can really penalise you.
Exactly.
And
thank you.
For those who are interested, ABIE, the network in general, you know, Europe-wide, we are making a submission to the Australian government on the tax residency ruling, or the proposed tax residency rulings. So if this affects any of you in any way, please do let us know, so we can add some of your thoughts to our submission.
I think Jennifer, the ATO have added that to the list of auto qualification requirements now. If you make a submission, you've interacted. So
Very good. Thanks very much for that, Adam.
yes,
so
yes.
On that note,
Geoff and David's details with us, please.
yes, and we'll also share, if Geoff and David don't mind, we'll share the presentation, so you've got that for your notes. Just on something else, we've got before we say goodbye to Geoff and David, we've got a wine tasting coming up on the 8th of July. The wine is super unusual. It's boutique wine, is not distributed in the Netherlands yet. And hopefully it's going to be our last virtual meeting. And so we can drink into the summer and say goodbye to virtual meetings, and then see each other again, save the date, for the 9th of September, where the ambassador will welcome us for a soiree at his residence in The Hague. So do save the date. Geoff, sorry you can't join us for any of those things. You're welcome.
Maybe next year.
When you can travel to Europe, we will welcome you here and also have a drink in person. So thank you everybody for joining. Thank you so much, David and Geoff. It was absolutely fantastic. And we look forward to sharing the presentations to everybody. So thank you.
Thank you, everyone.
Thanks,
Thank you,
guys.
everyone.
Thanks, Jennifer.
Thanks.
Thank you.